Hello, everybody. I'm Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Welcome back to Cup of Joe. It is great to see you again. So if you remember from our segment a month ago, we talked about not getting too excited about the strong returns that we saw in January. Well, February's passed and it provided a perfect example of why we are very careful not to get too far ahead of ourselves. So what happened in February? Well, in February, pretty much all asset indexes were down in about the minus 1.5% to 2.5% range, stocks and bonds included. So what was that? Lots of data came in that put a damper on what may have been some overly optimistic views of the economy, which caused market participants to really hit the ground running in January and lead to returns that seemed unsustainable. The data from February were minutes from the Fed meeting showed that they were steadfast in their scheduled rate hikes. They're sticking to it. Inflation didn't come down as much as investors had expected, or maybe hoped is a better word. Rumors of trade tensions between the US and China, February was when they really started to get a little louder. And on the earnings calls for corporations, there was this consistent theme from CEOs and analysts that they were cautious on the next few quarters, not necessarily excited. And this was especially true in the retail sector. So put that all together and February trended down after a really hot January. We're still in positive territory for the year as far as returns. So that's what counts. It's the direction, not the magnitude in times like this. But February was the cautionary tale of why not to get way too far ahead. Another thing that February was good for, it was an excellent illustration of how the stock market is not the economy, and the economy is not the stock market. If you took the returns from January, let's say on the S&P 500, it was about positive 6%. Extrapolate that out into an annual return and you're at plus 72% for the year. Obviously, no one expects an outrageous return like that. But when you take that 6% return in January and then put it in front of the backdrop of an economy that's not really showing any signs of being on the upswing, just based on optimism, then that pace of performance seems even more far-fetched. The old adage comes to mind of a lot of the time the market acts as a voting machine rather than a weighing machine, when it really should be a weighing machine. You've heard us say that before. The stock market is not the economy, and the economy is not the stock market. And it's real easy to forget that when the two can become detached, like they did in January. February brought us back down to earth. So where are we now? Well, we are kind of where we thought we would be. I just don't think we've gotten here the way we thought we would. If you remember our segment back at the end of 2022, we advised that it would be prudent to expect more volatility this year, especially in the first half of the year. Well, the market is still positive year to date, which is excellent, and the volatility is present, but we think it's a little more subdued. It's at much more manageable levels, and lately we've been seeing some daily moves of 1%, a little over 1%. They're certainly not happening in the streaks or the magnitude or the big weekly changes of 5, 6, 7% that we were seeing a year ago. So it's kind of the environment we expected to see. Of course, nothing happens quite the way you think it will, but we're comfortable with what's going on right now. Right now, it's very much a data-driven rat race, if you want to call it that, as market participants everywhere are looking to every economic report and inflation print and data release, just hoping to find the bottom to all this, and hoping that all those tea leaves will signal a turnaround, a sustainable turnaround for the stock market. So in this environment, we are being patient and pragmatic. Right now, cash is our friend. You're being paid to wait as interest rates have risen nicely. So your savings accounts are earning something, but also holding cash right now, that allows you to invest into volatility. You can lean into it through dollar cost averaging. And this practice ultimately improves your long-term outcomes. Also, bonds are once again providing meaningful income. And as the Fed inches closer and closer to its ultimate level where it stops hiking interest rates, the interest rate risk to the bonds in your portfolio, that starts to diminish as we get closer to that terminal level. So as this interest rate risk diminishes, we believe that bonds are also providing more of a ballast to stock market volatility. If we see some more significant volatility, especially to the downside throughout the year, because historically bonds provide a very good ballast to equity volatility within portfolios. So if you have any questions about anything we've talked about here or want to ask any questions of your own, please feel free to reach out to us at Argent Bridge, and we will be happy to provide you with clarity you need. Take care.